All right, so today we're going to do a deep dive into something super important, building a strong financial base.
Yeah, it's kind of like we're laying the groundwork for, everything you want to do financially.
Exactly. We're talking about the bedrock, the foundation.
Yeah,
We're getting down to the core principles that really make a difference when it comes to building wealth that lasts.
that's right. We want to give people those tools that they can use to build something that's going to last.
Yeah, that's going to provide stability,
Yeah.
help you navigate all the financial uncertainties that we know are out there, unlock those future opportunities.
And ultimately form the bedrock, like we said, of your long-term financial success.
It's interesting, right? We went through a ton of material, and what's amazing is how consistently 4 key areas just kept popping up, and they really are the core foundation.
Yeah, these are the big ones.
So we're going to go through each one in detail. First up, it's all about understanding the
Right.
financial literacy. Then we'll get into the practicalities of managing your money. That's budgeting and saving.
Gotta have that.
Then we'll demystify debt management.
Everybody's favorite topic.
And finally, we'll lay the groundwork for growing your money through investing basics.
All right. Sounds like a plan?
Ready to get started?
Absolutely. Let's dive in.
Okay, so foundation block number 1, financial literacy.
This is where it all begins.
And it's not just about knowing, the definition of an IPO.
Or being able to talk the talk.
Yeah, exactly. It's about developing this deep, practical understanding of how money works in your life and in the broader economy.
Right. It's like understanding the rules of the game before you start playing.
Yes, and what really struck me from all the stuff that we looked at is that financial literacy, it starts with some core concepts that may seem kind of basic, but they're really foundational.
You got to get these down.
It's the nuts and bolts of budgeting, saving, getting comfortable with investing principles.
The ABCs.
It's like understanding the grammar before you try to write the story.
I like that analogy.
And one of the key elements of that grammar is, this is what I found really interesting, the ability to read financial statements.
Oh, yeah. This is huge.
So we're talking balance sheets, cash flow reports.
Things that might sound a little scary at first.
Yeah, but when you actually break them down, it's not that complicated.
Not at all.
So for example, a balance sheet. Think of it as a snapshot of what you own and what you owe at a specific point in time.
Right. It's like a financial selfie.
And the key insight here is to look at the relationship between your assets. So that's things like your savings, investments, and your liabilities. Things like any debts you might have.
Exactly. You want to see how those two things stack up.
And a healthy balance sheet, generally more assets than liabilities.
Makes sense, right? You want to own more than you owe.
And it's not just about looking at the past.
Right. We got to look ahead, too.
The stuff we read, they really emphasize keeping an eye on current market trends, staying informed about broader economic shifts and opportunities.
It's like being aware of the currents in the ocean,
Yes.
You got to know what's going on around you.
So it's like understanding weather patterns can help you plan your day. Being aware of the economic landscape can really inform your financial decisions.
Exactly. You don't need to be a Wall Street expert.
Yeah, you don't have to get a PhD in economics.
But understanding those basic principles can help you make smart choices about your money.
And this is a journey, the sources really highlighted that.
Oh, yeah. It's a lifelong process.
Continuous learning.
Books, courses,
Finding a mentor, people who've done it before.
learn from their experience.
Okay, so we've got the knowledge base.
Now we got to put it into practice.
Now let's move to foundation block number 2, where the rubber meets the road, budgeting and saving.
Yeah, this is where we get into the nitty-gritty.
It might not sound as exciting as investing, but all the material that we read, they make it abundantly clear how absolutely essential this is
It's the foundation.
for building a solid financial foundation.
It all starts here.
Budgeting and saving, these are the practices that underpin all of your financial goals.
So the building blocks,
The first critical step, and this came up over and over again, is creating a realistic budget.
Not a restrictive budget, a realistic one.
It's not about deprivation,
No, it's about understanding where your money is going.
tracking both your income and your expenses.
Right. Seeing the big picture.
Think of it as a roadmap for your money.
I like that. A roadmap.
And once you have that roadmap,
Yeah.
you can start to identify opportunities to save.
See where you can tweak things.
The sources suggest looking for areas where you can potentially reduce spending without impacting your quality of life too much.
Right. It's not about sacrificing everything.
Maybe it's reassessing those subscription services that you don't use.
Or finding more cost-effective ways to enjoy your hobbies.
Finding deals, being smart about it.
Exactly.
It's about making those conscious choices that align with your financial priorities.
What's important to you?
And then comes a cornerstone of financial stability,
The emergency fund.
the emergency fund. Aim for 3 to 6 months worth of your essential living expenses.
Tucked away in an easily accessible account.
This is your financial shock absorber.
For those unexpected events.
Job loss, medical expense, major home repair.
Life throws curveballs, you gotta be ready.
And what's really fascinating here is the psychological security that this provides.
Oh yeah, knowing you've got that safety net can really reduce stress.
It allows you to breathe a little easier.
And it allows you to make clearer decisions in other areas of your life.
Yeah, because you're not constantly worried about that what if.
Exactly.
And to make this saving process even more effective, the sources we looked at, they consistently recommend automating your savings.
Make it automatic. Take the thinking out of it.
Set up those automatic transfers.
From your checking account to your savings account.
And you're consistently putting money aside without having to think about it each month.
It just happens like magic.
And that consistency is key.
It really is. It takes the emotion out of it.
Removes that temptation to skip saving.
And makes it a seamless part of your routine.
Okay, let's move on to foundation block number 3, debt management.
Uh-oh, the D word.
Debt, it can feel like this persistent headwind.
It can be a real drag.
And the sources we looked at, they start by drawing an important distinction between what they call good debt and bad debt.
Yeah, not all debt is created equal.
Can you elaborate on that for our listeners?
Sure, good debt is usually associated with investments that can increase your net worth or generate future income.
So things like a mortgage on a property that might appreciate over time.
Or loans taken out for education or to start a business.
Investing in yourself.
Right, things that can pay off in the long run.
Bad debt typically refers to consumer liabilities that don't really appreciate in value.
And often come with those high interest rates.
Credit card debt, loans for non-essential purchases.
Things you don't really need.
And the critical difference here is the long-term impact on your financial well-being.
One type of debt can help you build wealth, the other can hold you back.
It's about understanding whether your debt is working for you or against you.
That's a great way to put it.
And when it comes to managing debt, the sources we looked at, they really emphasized prioritizing repayment of that high-interest bad debt.
Get rid of that as soon as you can.
The idea is to minimize the amount you're paying in interest over time, because that can really eat into your progress.
It's like throwing money away.
They also talk about developing a strategic approach to debt repayment.
Have a plan.
And they often mention 2 popular methods, the snowball method, where you focus on paying off your smallest debts first to gain that psychological momentum.
Get those small wins. Feel good about your progress.
And then you have the avalanche method, where you prioritize paying off the debts with the highest interest rates first.
Save the most money on interest in the long run.
Both have their advantages.
It depends on what works for you.
The best approach might depend on what keeps you motivated.
Some people need that quick win. Others are more focused on the numbers.
But one really crucial point that came through in all the material,
This is a big one.
the importance of avoiding accumulating new unnecessary debt in the first place.
Stop digging the hole deeper.
It's like trying to bail water out of a boat that has a leak. You got to plug the leak first. Let's move on to our final foundational block. This is where your money has the potential to grow over time. Investing basics.
All right, let's talk about making that money work for you.
Investing, and this can often feel like a really complex and intimidating topic for a lot of people.
Yeah, it can be a bit overwhelming.
But the sources we examined, they really focused on demystifying those fundamentals.
Breaking it down into simple terms.
And one of the first things they consistently mention is understanding your own risk tolerance.
How much risk are you comfortable with?
And what does that practically mean for someone who's just starting to think about investing their money?
Risk tolerance is basically your comfort level with the potential for investment losses in exchange for the possibility of achieving those higher returns.
It's like a trade-off.
Yeah, higher risk, higher potential reward.
And it's also closely linked to your time horizon.
How long do you have to invest?
How long before you might need to access that money?
Right, if you're younger and have many years until retirement.
You might be more comfortable with a more aggressive approach.
One that carries a higher potential for both gains and losses.
But if you're closer to retirement,
You might prefer a more conservative approach, focused on preserving capital.
and generally the sources categorize risk tolerance into these broad categories.
Conservative, moderate, aggressive.
Understanding where you fall on that spectrum.
That's an important first step.
And then the sources we looked at, they talked about this fundamental principle of diversifying your investment portfolio.
Don't put all your eggs in one basket.
How is spreading your investments across different areas so important?
Diversification is the strategy of spreading your investments across different asset classes, such as stocks, bonds.
And potentially other areas like real estate or commodities.
The idea is that different asset classes tend to perform differently under various economic conditions.
So if one area of your portfolio is experiencing a downturn,
Others might be holding steady or even increasing in value.
which helps to reduce your overall risk,
Exactly. It's all about managing that risk.
and index funds, which were mentioned frequently,
Those are a great way to achieve instant diversification,
because they track a broad market index.
essentially holding small pieces of many different companies.
So it's about not being overly reliant on the performance of any single investment or sector.
Spread that risk around.
And finally, when it comes to investing, the sources we examined, they repeatedly stress the importance of thinking long-term.
This isn't about getting rich quick.
No, it's not about chasing those short-term fads.
It's about building wealth steadily over time.
And they emphasize that building wealth through investing, it's typically a marathon, not a sprint,
Slow and steady wins the race,
focusing on that sustainable growth over the long haul.
rather than trying to time the market,
And they also highlight the incredible power of compound interest
where your earnings start earning their own returns.
and the importance of making consistent contributions to your investments over time.
It's like a snowball rolling downhill. It just keeps getting bigger.
That patient, disciplined approach, that's often the most reliable path to building significant wealth. Okay, so we've explored these 4 foundational blocks.
The cornerstones of financial success.
How do we actually put all this together in a cohesive way?
That's where the blueprint comes in.
A wealth-building blueprint.
It's about integrating all of those elements, making them work together.
And our sources really underscored that consistent effort and unwavering discipline, it's crucial.
This is not a set it and forget it type of thing.
It requires ongoing attention and commitment.
You got to stay engaged.
And life is going to throw us curveballs. Things are going to change.
Yeah, you got to be prepared to adjust.
The sources we looked at, they advise regularly reevaluating and adjusting your financial strategy as your circumstances evolve.
Things change, your plan needs to change too.
What kind of events might prompt someone to kind of take a fresh look at their financial plan?
Well, significant life changes, like a change in income, getting married or divorced,
Having children,
changing careers.
all of those things.
Those are all good times to reevaluate your financial situation and your overall strategy.
And they also wisely suggest seeking expert guidance from qualified financial professionals.
Like a certified financial advisor.
When you encounter situations where you might need some specialized advice,
Yeah, get a second opinion.
sometimes having that objective expert perspective can be really helpful.
Especially when you're dealing with complex financial issues.
And finally, our sources. They encourage celebrating your progress along the way.
Yeah, don't forget to pat yourself on the back.
Why is it important to acknowledge those financial milestones, even the small ones?
Because it helps you stay motivated.
It reinforces those positive financial behaviors.
It's like a reward system for yourself,
It reminds you of the progress that you're making.
which can be really encouraging over the long term.
So to bring it all together,
The 4 foundational blocks.
for creating a strong financial base, financial literacy, budgeting and saving, debt management, and investing basics.
Those are the keys to the kingdom,
And they're not independent concepts. They all work together synergistically
like pieces of a puzzle,
to build that robust framework for your financial well-being.
and your future prosperity.
Now, the call to action for you, our listener, is to take one small financial step this week.
Doesn't have to be a huge thing.
Something tangible. Start putting these principles into practice in your own life.
Make it a small win.
Whether it's creating a basic budget, researching emergency savings accounts, exploring different low-cost investment options.
Just take that first step.
That initial step is often the most challenging, but it's also the most important.
It sets the wheels in motion.
And to support you in this, the sources we examined, they recommend exploring the wealth of resources that are available out there.
There's so much information out there.
Reputable books, informative websites, online courses dedicated to various personal finance topics.
You can learn so much on your own,
And if you feel like you would benefit from some personalized guidance,
tailored to your specific circumstances.
consider reaching out to a certified financial advisor who can provide you with that tailored advice.
They can help you create a comprehensive financial plan.
So as you reflect on our discussion today, consider which of these foundational blocks resonates most strongly with you right now.
What's your biggest financial challenge at the moment?
And what would a single actionable step within that specific block look like for you this week?
Think about one concrete thing you can do.
That's your challenge and your opportunity as you continue on this journey toward building a truly strong and sustainable financial base.
We believe in you.
Thanks for taking this deep dive with